Is the bond market flashing a warning or an opportunity? Let's take a closer look at what's moving financial markets right now. First up, U.S. Treasury yields hit new 2024 highs. This week, yields on 10-year U.S. Treasury notes climbed to their highest levels of the year, briefly crossing 4.6%. The driving forces include fresh inflation data showing consumer prices are rising faster than expected, as well as persistent concerns that the Federal Reserve may hold off on rate cuts longer than many investors hoped. Why does this matter? Treasury yields are fundamental to the pricing of everything from mortgages to corporate borrowing, meaning higher yields can cool economic growth and weigh on equity valuations. And there's more. As rates rise, existing bond prices fall, which can lead to portfolio losses. Where do we go from here? Analysts will be watching upcoming Fed commentary for signs of a policy shift and keeping close tabs on inflation reports. If yields continue to climb, expect volatility in both bond and stock markets to escalate. Let's move to our second story. Tesla shares slide after Q2 delivery miss. Tesla stock fell sharply after the company announced that its second quarter vehicle deliveries missed analyst estimates, with approximately 435,000 cars delivered versus expectations of nearly 450,000. CEO Elon Musk cited continued supply chain challenges and shifting consumer demand, especially in key markets like China and Europe. Why is this significant? Tesla's ability to meet delivery targets is closely watched as a bellwether for both the electric vehicle market and the company's own profitability. Missing targets tends to put downward pressure on share prices and raises questions about future growth. The broader context here is increased competition from both established automakers and new entrants, making it tougher for Tesla to maintain its dominant market share. Investors should keep an eye on earnings guidance next quarter and watch for updates on new model releases or strategic shifts that could restore confidence. Let's turn to our final topic. Eurozone inflation rises unexpectedly in June. Inflation in the Eurozone picked up to 2.6% in June, surprising economists who had expected a slowdown. Energy and food prices were among the biggest contributors to the uptick, but underlying core inflation also edged higher, complicating the picture for the European Central Bank. Why does this matter for markets? Expectations had been building for the ECB to start easing monetary policy, potentially lowering rates to support growth. However, persistent inflation may force policymakers to keep interest rates higher for longer, potentially dampening economic momentum across the euro area. Looking ahead, markets will be watching upcoming policy meetings and inflation data closely, as any signs of a sustained price spike could trigger additional market moves, especially in European bonds and equities. To sum up, rising U.S. Treasury yields, Tesla's delivery shortfall, and stubborn Eurozone inflation all highlight the delicate balance central banks and investors are trying to navigate in 2024. The coming weeks will be critical as more data emerges and policymakers signal their next moves. Investors should keep a close eye on interest rate expectations, corporate earnings, and inflation indicators on both sides of the Atlantic. Drop your thoughts in the comments, and if you enjoyed the video, give it a thumbs up. Don't forget to subscribe and hit the bell icon. Thanks for watching. See you next time. This is not financial advice.